Hello and welcome to a brand new show of Markets and More with Sunil Singhania, a show which promises to just not talk or stick to markets. We'll talk about market, life, money-making opportunity and reflections of a maverick investor like Sunil Singhania. Sunil, welcome back. The first show, I must admit, it was more like a startup show, but we got a great response and it was very well applauded and accepted by our audience. So thank you for that. When we met last time, the buzz was all about election. Who's going to win? What would be the nature of the mandate? And typically, markets were volatile and nervous. But now that the mandate has changed, I guess it's time to change the market narrative as well.
I think on a lighter note, markets are still nervous. So markets over the last 18 months have found newer reasons to get nervous. But having said that, I think this was a big event. And, obviously the mandate has been much better than what the market expected. I can tell you from my travels in May abroad that the global investors in particular are now looking at India as one of the very few economies where there is going to be a political and as well as an economic stability over the next 5 years. And I think that is what the elections have done to the markets. Obviously, there are newer challenges, which we'll discuss whenever we want to, but I think the big event is behind us now.
Okay, to simplify it for our viewers, what you're saying is that the world is uncertain. There is a global macro risk and there is a political risk because of the fact that new governments would be voted to power. But in India, the macros are stable and the political environment is stable. So if in rating agency, you would say India is AAA and the world is BBB?
So if you look at the world, obviously in the Euro region, particularly because of Brexit-related likely changes in the UK leadership, it's uncertain. US goes into election in 2020, and political parties and politicians globally obviously are the same. The first priority for any politician is to win the elections, and I am very sure that for Trump also it would not be any different. And therefore, there is going to be this war of rhetorics which will continue for the next 1 year, whether it is trade war or some announcements about China, India, Mexico, and so on and so forth. China continues to be always a black box. So then if you actually see, India stands out as one block where for 5 years we have a mandate. And in terms of economic policies, we can only improve from here. So I think that really stands out. I don't know whether it will be AAA versus BBB. But at least on the policy front and the political front, this kind of stability is what attracts foreign investors. And it is also reflected in some of the other macro indicators. So you see currency, which had touched 74 and it was expected by a few pessimists to touch 85, back to below 70. You have GSEC yields, which had at one point of time in the very recent past hit a high of as high as 8.25, come down to below 7. We have already had 3 rate cuts from our central bank, and maybe a few more would be expected. Liquidity, at least on the broader level, is coming back. There is some crisis of confidence, largely because of some groups and some NBFCs facing issues. But generally, I think there is definitely liquidity coming back. So on the top level macros, India clearly stands out. And I think that is a big, I would say, positive from a global investor's perspective.
Now that data point will just come up on your screen that how macros are now looking positive for India. Oil in and around 60, rupee below 70, and the bond yields in and around 7%. These are typical indicators which will make a macro bull very bullish. Now Sunil, before we talk about the next 5 years, which is what we must do in a market show, let's talk about the last 5 years. Last 5 years, India one regime, the mandate was stable, oil prices were benign, global growth was good, and we were on the right side of the world in terms of a positioning. But yet Indian markets in local currency terms, I'm not even talking in dollar terms, have not given gangbuster returns. We simply have managed to map the global environment. So my question is that the global environment, at least in the short term, is looking slightly dim, which means that one should not get carried away because of the mandate. I mean, if those who are getting carried away because of the mandate, will they get trapped in euphoria?
So the good thing about this time is that post-elections we have not had a 20% circuit up and a 30% rise in the market over a 1 month period. We have been doing well, but I think 1 year returns for Indian markets have been like 5-6%. So it's not a euphoric kind of, I would say the markets have not taken the mandate in a euphoric manner. You talked about the last 5 years. In fact, if you go back into 3 blocks of 5 years each over the last 15 years, Indian markets have more or less given around 50 to 60% absolute over each 5-year blocks. And that is predominantly mimicking the GDP growth in rupee terms. So I think on a broader basis, that is a very fair estimate for any investors to work with. That if the GDP between 2019 to 2024 grows by 60% in rupee terms, then the market should logically, I'm talking the large cap, should logically give that kind of returns. Obviously, there will be some alpha to be made. In terms of the last 5 years also, we have to remember that the first 2-3 years of the government was a very difficult period because our fiscal deficit was very, very high. We were coming out of the shock of oil having hit over $100, so that burden had to be borne. There were 2 path-breaking reforms, we'll not go into whether they were positive or not, but demonetization GDP, which caused disruption between 12 months to 18 months, and that also impacted. It is only in the last 1 year that a lot of spending on infrastructure started to happen. And hopefully the next 5 years, the government would complete the unfinished agenda. So I think the next 5 years, at least I'm an optimist that it's going to be much more transformative in terms of focus on growth than the first 5 years.
But if your assessment is that in a 5-year block, we've got about 50 to 60% return, so then irrespective of what the world view is, a 50-60% return for benchmark indices is coming. So just sit tight and don't worry.
So I think that is what investors should be looking at. So if the GDP is going to go from 2.5 to 6 or 7 trillion dollars, I think that is the wealth which is going to be created over the next 10 years. And that is the advice we always give to the investors, particularly the retail investors who get a little bit nervous with all what is happening. However, whether this GDP is 7% or 8%, that is going to determine whether you end up making 50-60% return in the 5-year block or maybe 80-90%.
Fair point. Okay. The other point which we want to address, and I think which everybody is trying to scratch their heads and trying to find the real answer, is that why is there a acute slowdown in all the high frequency data points? GDP is a function of economic activity, and GDP has plunged. Car sales have fallen off the cliff. Suddenly there is a gut-wrenching fall in FMCG volume, and a simple indicator like aviation growth, which was in late teens, almost at 20%, has suddenly plunged to levels of less than 10%. Sunil, I guess no one saw this kind of a slowdown coming.
Yes, and to be fair, I think the last 2-3 years, you had a slowdown on the industrial side, and it was the consumption which was keeping the economy going. So obviously this last 2-3 months slowdown in particular is a cause of worry, and it has to be tracked. Car sales obviously, but the Maruti chairman had come and said that this is a phenomena which is always there during election time. So let us see how June sales pan out. In terms of other consumption items also, you had a slowdown. However, I was speaking to a couple of companies, last week, towards the late last week. And the indication which we are getting is that March and April were really challenging. May there has been some revival. And the first 10 days of June have again seen some revival. So I would say that we should not take this slowdown as a trend. We are a growing economy, we are a young economy. To just repeat, 65% of our population is below 35 years of age. Standard of living is improving. So I think this segment is definitely going to grow, and that is going to keep the economy alive. There was also a little bit of slowdown, particularly in the vehicle sales, whether it is commercial or passenger, because of some issues with NBFCs. Hopefully that will also get resolved. So we are quite optimistic that in the run-up to the festive season, and hopefully with a normal monsoon, this would just be sort of a near-term speed breaker rather than a trend.
You've always argued, and when I say not always, but last couple of years on various forums, you've argued that India is a consumer-driven economy, but don't buy consumer stocks because it's like saying you're buying gold at the price of diamond. Is now gold available at the price of silver?
So I would still believe that a lot of consumption stocks still trade at significant premium to their fair value. particularly on the staple side. So consumer staples where the volume growth is not going to be more than 4-5%, at least I am not in the camp which will give 60-70 PE multiples. However, on the other hand, there are consumption stocks which are on the discretionary side, and where once the economy starts to move up again on a rapid pace, the growth rates can be much significant. I think there is value. And again, stocks which are in that 5,000, 7,000, 3,000 crore market cap, which people are ignoring, there are some consumption names and good companies, decent companies, where there can be value. So I would say that even within the consumption basket, focus on consumer discretionary. The consumer staples are still expensive. And even within the consumer discretionary, see if you can find good brands which are in that, the smaller or mid-cap category, which is right now being ignored. And I think a lot of money is going to be made, because ultimately we have seen in the world, if Starbucks can have 10,000 outlets in the US and McDonald's can have thousands of outlets in US, a lot of businesses in India also have multiple opportunities to grow.
Okay. Now in this segment, reverse swing, we'll keep it simple. And a theme of this episode of Markets and More is not only to educate you, but also to guide you to reach your financial goals. And how can you really revisit your investment approach? Because investing, like Sunil always mentions, it is just not a science, it is a combination of thoughts, trends. So bottom line here is that investing has to be learned, it cannot be taught. But with Sunil on the show, I'll make it very simple for you. So Sunil, we'll get into this explainer as to how investing can be learned and not taught. But right now, the objective is to help our viewers make money. How can one make money in this market?
So one is very clearly, be confident about India as an investment destination. I think that is the most important thing. See, I always jokingly tell, my friends and our investors that unless you're optimistic, you should not be an equity investor. You can't invest in equity and then point to 20 negative things which are going to happen. I think you just discuss it earlier, and then if you're not confident, don't invest. So I think you have to be optimistic. Second is, these phases of some stocks doing well, some sectors doing well will come and go. Don't get carried away by the themes. So right now, what we are seeing is, because what has happened over the last 18 months, no one wants to look at the smaller companies. Everyone just wants to be in the best names. And the best names might not be the best stock, So I think we have always been taught that as a portfolio manager, the objective is to buy good companies, which can also be good stocks. It's not that you buy good companies which are so expensive that it doesn't make sense. So I think that space of mid caps and small caps is some place where it makes sense to start nibbling from now on.
But you are a compulsive mid cap bull. It comes naturally to you.
Yeah, because the past has been so profitable compared to the large cap. So, we discussed that last 5 years, Nifty has given 52% return. If you actually see, despite the last 1 year of challenges for mid cap and small cap, if you see the last 5-year returns, mid caps and small caps have done significantly better than Nifty. So I think there is more volatility, but we are a growing nation. There are new themes which will come up. Smaller companies are entrepreneur driven. They will have the passion to grow faster. And smaller sectors, government also doesn't interfere, so they naturally grow faster. So I think if the view is that this next 5 years are going to be transformational, which I have, I think this is a segment which no one should ignore. And as I said, it's possible that for 3-4 months, nothing happens, but you can never time them to perfection. And the time to buy is when no one is looking at them.
As an investor, you always aspire to buy a small cap which could become a mid cap, and a mid cap which would become a large cap. And you don't like to buy too many large caps, because large caps, if they become mega cap, the returns may not be that great, because those are discovered businesses. So if I have to, let's say, rewind the show, and if we are talking 5 years, and if we are discussing the ND2 regime, which small and mid cap businesses, themes or ideas have potential to migrate to a different orbit? Small could become mid and mid could become large.
So I'll give you my perspective. I think what would logically the new or the second term of the government do? Obviously focus a lot on infrastructure. That is their stated objective: road for all, housing for all, connection of rivers, more airports. So I think that infrastructure is definitely going to be there. The other thing is it's becoming a more efficient, sector. So I would say that some of the larger or I would say more stable EPC companies definitely are worth a look. Cement, obviously, since the last show, have moved up. But whenever you get an opportunity, it's an ancillary sector that should do well. The government objective is to double the farm income, improve prosperity. So obviously, consumption as a theme, no one can ignore. And as I said, you have to look at companies which can grow faster, which are discretionary spending. It's not what you are already doing where the the penetration is low. I think that again NDA 2 would be a big thing. I think a lot of work will be done on the agricultural side. So whether it is as I said, more income, more irrigation. The government has talked about water as more resources. Nal mein jal is a slogan which they have. So a lot of impetus on water. Financial services has undergone a lot of issues over the last 12 to 18 months. But at least our internal estimate is that now more or less 90-95% of the NPAs have been adequately recognized. So there will be new incidents coming here and there. But by and large, that sector is now set to focus on growth. And big money is made when growth happens. So, financial services company which have the balance sheet which can grow. I think again, so these are the 4-5 sort of themes which you can look at. On the export front, because of this trade war, if the government focuses on labor reforms, which would be one of our key demands or advices that focus on labor reforms, then some of the labor intensive industries, whether it is garment or shoes or chemicals, even pharma, which are dependent on exports but which also needs a little bit of labor reforms, I think those would be very exciting sectors also.
Let me pour cold water on the 15 minutes of optimistic talk we've had, which is a visible fear of trade war. Chinese are not talking to Americans, Americans are not talking to Chinese, Americans are saying that we want a trade war, Chinese are saying we don't want a trade war, if there is one, we will certainly not keep quiet. We've not seen the world has not fought over trade for many decades now. And nobody is able to come out with a complete scenario. What is your sense? Will this hurt India? Will this benefit India?
So actually, if you see the history of the world, I think after 30 years, maybe we are seeing a world where there are so many strong leaders. And strong leaders obviously come with a little bit of ego also built in. Also, as I mentioned earlier, 2020, there's an election in US. And obviously, a lot of these talk also improves the chances because, bashing China obviously helps, in the US particularly. So I think this war of words will continue. But, we are talking about big disruption and slowdown. And the last 1 month, we have seen the peak of all these issues. But still, both US and Chinese markets are positive on a 1 month basis. So, there is volatility, but the markets swing back also equally fast because everyone realizes that no country can afford a full-fledged trade war.
This is not complacency?
Sorry?
This is not complacency according to you, that the news is bad and markets are going higher?
I can see the other way around, that there are so many negative people already on the street that negative news is not impacting the market because those who don't want to buy are already out of the market, But the ancillary benefits of all this is that oil is weak, which helps India. Already companies in the US have started looking at alternative sources apart from China. So obviously, there is talk that Mexico and Vietnam and some of the East European countries would be major beneficiaries. But India can also be that second source because it's a large economy, So I think I'm an optimistic and I always try to see what can be the positives rather than what can be the negatives.
I wonder if we have to plan a show and when I insist that you cannot use the word optimistic and bullish, how will the show start and how will
we'll
the show
find
end?
some other words for it. Hindi mein karenge.
Okay, the next topic which we discussed is the disruptive wave. We spoke about food delivery companies, the impact it's having on our food habits, how we are enjoying cricket matches by watching a pizza. But what we haven't discussed is that when we are paying for that food delivery, we are using an app. So now the next wave, according to you, could be the way how India is making payments?
It's already happening actually. If you see our own internal habits, maybe we used to use our credit card once a month. Now we use 5 times a day. For small payments like 20 rupees, 50 rupees, 100 rupees also, there are ways of paying, whether you use Paytm kind of apps or UPI or even cards. And I think that is going to bring in a lot of efficiency. Our tax GDP ratio is one of the lowest in the world. I think if you are just able to improve it by 2% by better compliance, I think there will be no fiscal deficit in India. What it also is doing is encouraging a lot of businesses because of ease of transfer of goods as well as transfer of payment. I think this concept of UPI is a sort of a dream. I think India is much ahead compared to most countries. And in fact, the QR code system and the Bharat Pay and all are now sort of being exported in terms of services. So I think it's a great sort of move forward. As I said, it's now fully traceable. You can't sort of disguise your
every rupee has an address now.
And it will pinch people who are not compliant for a little bit. But I think the ease which it brings to our lives will take us to what some of the developed world is moving to. And I think I would say that our tax to GDP ratio can really go up because of this.
That's the broad impact. But financial investors, apart from looking at the broad trend, they always look at opportunities. It's like saying when the gold rush, California gold rush happened, the money was made by Levi's jeans. Which companies would benefit? Is this bad news for banks? Is this bad news for credit card companies? How will this entire thing pan out?
So it's a trend in the world that fees are going to fall. So obviously the credit card companies who are enjoying 3-4% a month, I think they will definitely have to squeeze out. On the banking side, very clearly you have to now be technologically much ahead, because you don't need branches technically. I haven't visited my bank branch for I don't know how many years because you don't need to go to a sort of a physical branch. So the advantage which some of the old banks had of a big branch network might suddenly disappear, because if people get used to transacting without paper, I think that will happen. And some of the new age banks are making tremendous use of this. And I think those are the banks which an investor need to focus on. Even in our own business, asset management and the wealth management, I think everything is now moving towards online. So unless you are up there, you are going to face a lot of pressure. But I said there will be businesses also which will benefit out of it. You talked about deliveries and all. I think it was a hassle to make payment by cash. It is to unnecessarily that poor guy had to wait for 10-15 minutes, find changes. I think you are increasing efficiency. So it is going to be good for all the businesses, but obviously the businesses which would change or transform themselves would be the biggest beneficiary.
All great investors, they say that before they invest, they reflect a lot. A 25-30-year career, it's full of stories. You've seen the world go up and down and then up and down. When you reflect back and you assess the NDA 1, what is your reflection telling you?
So there was a lot of hope and expectation, and I think that is the reason why when the mandate happened, the markets were up like 25-30% in a matter of days. A lot of work was done. Obviously, we as human beings and particularly as Indians always expect much more. And to that extent, there was a little bit of disappointment. There were two reforms which we mentioned, GST and demonetization, which did cause a near-term turmoil. I think NDA 2, according to my expectations, would be very transformative. The first 15 days, the words have only been on development. It's the old non-essential words are all behind us. We have seen the RBI cut interest rates by 25 basis points. The tweaking of the NPA provisioning. It's a small thing, but it was needed. We have already started reading about labor reforms in the newspapers. The FICCI chairman has been very vocal in saying that the trust between the industry and the government is at the lowest level ever. So I think all this should be sorted out as we move forward. And for a change, this 5-year term, we are going to begin with NPAs going to fall rather than rise, because the banking system and the credit disbursal is very important for the country to grow. I think if we are able to marry that with huge inflow from global investors, which at least I believe that we'll have record inflows over the next 5 years, both in terms of FI and FDI, we can be back to 7.5–8% growth. And I think the reflection, if you go again the last 20–25 years, we have seen so many periods when you feel that, abhi kuch nahi hone wala hai. And then at the end of 5 years, you have seen your money double. So I think, as I said, I am an optimistic, but I think this 5-year period is looking like a transformational period.
Even though we've used the word optimistic very loosely, we'll leave on an optimistic note. Thank you for joining us and thank you for watching the show. Thank you for tuning in, and we'll see you soon with a brand new show of Markets and More.